Welcome, everyone. So, as financial analysts and business students, we're basically setting out on a journey today to uncover the true intrinsic value of a firm. If you've ever wondered how analysts actually figure out what a company on the Philippine Stock Exchange is really worth, well, you're in exactly the right place. Today, we're completely demystifying financial statement analysis in this explainer, and we're going to be using some awesome real-world examples right from the Philippine market. You see, valuing a firm in the wild, totally unpredictable sea of the capital markets, it's no easy task. You can't just guess which way the wind is blowing and hope for the best, right? Financial statement analysis is basically our compass. It provides a clear direction amidst this massive sea of complex economic data, helping guide our real-world investment decisions. So here's our agenda for today. 1. Navigating financial statement analysis. 2. Industry and company strategy. 3. Assessing financial statement quality. 4. Analyzing profitability and risk. 5. Forecasting and firm valuation. And finally, 6. Capital markets and information. Let's get right into it.
Section 1, Navigating Financial Statement Analysis. Okay, let's dive into this. This flowchart right here is our ultimate blueprint. It's a wonderfully logical sequence, really. We start super broad in steps 1 and 2 by identifying industry economic characteristics and company strategies. Then we move down the funnel, assessing the quality of the financial statements, analyzing profitability and risk, projecting out into the future, and ultimately getting to step 6, valuing the firm. It's basically a chain that maps everyday accounting fundamentals straight into stock price expectations.
Moving on to Section 2, Industry and Company Strategy. Now, zooming in on those first 2 steps, Porter's 5 Forces framework perfectly captures the competitive battlefield a company actually faces. Think about the Philippine fast food industry for a second. If you're evaluating a giant like Jollibee, you've got to look at the high bargaining power of buyers, their intense price sensitivity, and the wild volatility of raw ingredient costs from suppliers. Alongside Porter's, we also use the Economic Attributes framework. This helps us see exactly how the underlying demand, manufacturing dynamics, and marketing shape this intense competition, which ultimately dictates everyone's profitability. So how do you survive those 5 forces? Well, a firm absolutely has to establish a strategic competitive advantage. And this requires value chain analysis, looking closely at how the entire sequence of activities, from creation all the way to sales, adds value. Take SM Prime Holdings, for example. They leverage a massive, fully integrated nationwide value chain of malls, residential spaces, and offices. Doing this lets them sustain cost leadership and differentiation, which kind of shields them from localized economic risks. It's really smart.
All right, let's pause our journey for a super quick knowledge check. Based on how strategy impacts a business, which of these relationships can actually be directly observed in the financial statements? Is it A, marketing strategy, B, profitability, C, corporate social responsibility, or D, competitive product pricing? Take just a second to lock in your answer. Okay, if you guessed B, profitability, you hit the nail on the head. While marketing and pricing strategies are, of course, absolutely crucial, profitability, along with growth and risk factors, are the true economic relationships we can actually observe and measure in the cold, hard numbers.
All right, Section 3, Assessing Financial Statement Quality. Let's see how this all builds together. Step 3 is all about checking if the accounting reflects reality. Our first major piece of evidence is the balance sheet, which is basically a snapshot of a company's resources or assets and the claims on those resources, liabilities and equity, as of one specific date. But we have to assess the quality of this reporting. For example, when we're evaluating Philippine real estate developers like Ayala Land, we really need to scrutinize their balance sheets to see exactly how they record receivables for residential units sold on long-term installment plans. We have to ensure their accounting actually reflects true economic reality, not just paper game. Next up is the income statement. Unlike the balance sheet, this measures performance over a specific period of time. Because it uses the accrual basis of accounting, meaning it recognizes revenue when it's earned and expenses when they're incurred, regardless of cash, it requires some serious scrutiny. Just like those installment sales in real estate, we've got to verify that a company's revenue recognition policies aren't masking any underlying risks. We want to be totally sure that the net income truly represents their periodic performance. But as they say, cash is still king, which naturally brings us to the statement of cash flows. This statement totally completes the picture because it tracks the exact lifeblood of the company's daily operations. It strips away all those complex accruals and organizes every single actual dollar that comes in and goes out into 3 need buckets: operating, investing, and financing activities. Time to hit you with another rapid-fire interactive check, just to make sure you can easily distinguish between these core financial statements. Here we go. Which financial statement presents a snapshot of a company's assets, liabilities, and shareholders' equity as of a specific date?
And the answer is the balance sheet. Remember, the income statement and the statement of cash flows cover a period of time, like a whole quarter or a year. But the balance sheet? It's the only statement acting as a single, frozen moment in time, literally just a snapshot.
Moving deeper into the funnel, we reach Section 4, Analyzing Profitability and Risk. To actually apply mathematical tools and measure performance across wildly different-sized firms, we use common-size financial statements. This brilliantly converts massive dollar amounts into simple percentages of total assets or revenues. It completely standardizes the data. On the flip side, we have percentage change financial statements. These are super useful because they highlight relative rates of growth from year to year, instantly showing us the true historical trajectory of the firm. Beyond just percentages, we also calculate key financial statement ratios, like earnings per share or return on common equity, which act as powerful signals for future performance. But remember, ratios also expose risk. Think about Philippine Airlines, or PAL. By computing their net profit margins right alongside their debt-to-equity ratios, we can evaluate exactly how their profitability holds up against some extreme risks, like highly volatile jet fuel prices and heavy foreign exchange liabilities. And now for the climax of our journey, Section 5, Forecasting and Firm Valuation. So the absolutely crucial point here is that all our historical analysis is really only valuable if it helps us accurately project the future. First, we forecast. For instance, you might project future revenues for Converge ICT solutions based on expected fiber internet adoption rates rolling out across provincial regions. Then, step 6, we map those forecasts into an estimated intrinsic share value using valuation models. Armed with these models, we could actually estimate the fair stock price of, say, Century Pacific Food to figure out if its shares listed on the PSC are currently undervalued or overvalued today. Let's zoom all the way back out to the real world. Section 6. Capital Markets and Information.
Now, if you want to run your own analysis, you're in luck. Publicly traded companies are mandated by regulators to provide standard documents. Whether you're looking at the US SEC or the Philippine Stock Exchange, you'll rely on annual reports, comprehensive 10-Ks, 10-Qs, and prospectuses. A little pro tip, the Management Discussion and Analysis, or MD&A section within those reports, is literally an absolute goldmine for qualitative context. Don't skip it. But you might be wondering, hey, if all this information is totally public, isn't it already baked into the stock price? Well, as this quote points out, equity markets aren't perfectly efficient. Yes, security prices reflect aggregate market knowledge, but because markets aren't perfect, rigorous financial analysts are the ones doing the heavy detective work. They do the deep analysis and engage in the trading necessary to close that gap and increase overall market efficiency.
All right, we've covered some incredible ground in this explainer, but I want to leave you with a really fun situational challenge. Let me know what you think in the comments. Imagine you are an equity analyst evaluating Miggy Mango Enterprises, a rapidly growing mango dessert franchise aiming for a PSC listing. They are facing intense market saturation from rivals like Max's Mango, plus serious supply chain cost pressures tied to seasonal Carabao mango yields. So, using Step 1 and Step 2 of our framework, how would you evaluate the impact of Porter's 5 forces on Miggy Mango's position? And what specific strategies, like maybe value chain integration or geographic expansion, should they pursue to build a sustainable advantage? I'd love to read your thoughts. Keep analyzing, and I'll see you in the next explainer.